Hi guys, it's Tim. I'm the head of content and the investment lead for Team ProsperUS. I've got over about 10 years of content experience in the financial industry, including stints at Schroders and the Motley Fool. And I passionately believe that successful long-term investing is within everyone's reach. I hope to share that key message with you guys and get a new generation of investors excited about building long-term sustainable wealth through the stock market. So today I'm going to be talking about the post-pandemic economy, S-REITs and US tech stocks in 2022 and beyond. So a lot has changed in the pandemic, obviously with both retail REITs and with US tech stocks. And so I'm going to kind of take you through that and see how that has changed and where you guys can position yourselves for next year and then hopefully over the next decade as well. So let me go through the usual compliance disclaimer here. Obviously, this is my own personal opinion, etc., etc. And please don't take this as personalized financial advice. Okay, so let's hit up Singapore REITs and the future first off. I think that's a good place to start since, you know, we're all based in Singapore and we're kind of viewing this, you know, looking at investing in real estate. So how is the REIT market changing? I think first off, we can understand that retail has taken an absolutely massive hit during the pandemic for understandable reasons. There were global lockdowns. You know, a lot of things were shut. Even in Singapore, things are opening and shutting quite frequently. So there's no visibility for a lot of these retail REITs in terms of their income. And obviously, for some of their tenants, there's even more uncertainty. So here are a couple of examples, you know, of headlines just recently looking at retail property rents in Singapore. They're continuing to slide in the second quarter of this year. That's both on a year-on-year basis and on a sequential quarter-on-quarter basis. And if you're looking at differentiating between what matters in the REIT space, I think you have to really look at commercial REITs as well, because I think commercial REITs, there's going to be differentiation between grade A office space and grade B office space. And you're already seeing that start to play out with the rental gap starting to widen between grade A and grade B. So the demand, we're not sure what it's going to look like post-pandemic. Obviously, I think there will be some sort of hybrid arrangement for most workplaces where there's going to be a mix of obviously work from home, but also going into the office. But how that's going to impact long-term demand for office and commercial space is still unclear. So business as usual, is that coming back? I don't think so. And we can kind of see that already, as I just mentioned, with the CBD grade A and B rents. The spread between CBD sort of grade A and B rents is widening, and it's actually at its widest point now since 2015. So you can see that demand is still kind of holding up for grade A office space. It's come down obviously during the pandemic, but the forecast is that this spread is going to widen over the next few years. And in terms of the retail trade mix, what's happening is you're seeing a lot less food and beverage come into the mix, and you're kind of seeing a move towards different types of use of retail space. So going forward, retail REITs are going to have to be really, really creative with how they're using their space to try and get people through the door and to get footfall increasing. And that's going to have an impact on what type of REITs you want to be positioned in, especially in these sectors, or even if you should be positioned in these sectors, because there is always that long-term risk, I think, that it won't play out as you expected. So this is my own focus on, you know, REITs key metrics. How should you be picking the best REITs, the top REITs in Singapore? Because the REIT market in Singapore is really wide. Obviously, it's grown itself into a REIT hub of sorts in Asia Pacific. Lots of REITs are listed here. And so if you look at what you should focus on, I try and distill it down to 5 key things. So number one, there should be a low gearing ratio. Basically, you've got the debt headroom for the REIT to keep growing its portfolio sustainably, and it's not going to have to pay a lot for that debt either. Number two, there's a strong sponsor. If you look at some of the best performing REITs over the past 5-10 years, they've all been led, or they've all got a really strong sponsor, which gives them the firepower financially to acquire, and it also gives them the pipeline of acquisitions that they can add to their portfolio and grow. Number three, diversification. This is something that's played out over the past sort of 2-3 years. You're seeing a lot more Singapore REITs actually go overseas and buy real estate assets overseas. So it's no longer just a pure Singapore play when you buy a REIT. You're actually buying global real estate assets in a lot of these cases. And so I think the diversification by not only geography, but sometimes by the types of properties that they're buying. I think this is going to be a real key differentiator between the winners and the losers. Number 4, consistent distribution per unit increases. So basically that dividend per share that you're getting. I think you basically want to see a consistently rising DPU. It doesn't really matter on the distributable income line, whether that's increasing, jumping. There could be, that could be mixed up with capital raisings or equity raisings. So the key number you need to look at is that DPU, because the DPU is going to tell you whether you're getting more money in your pocket at the end of every quarter or at the end of every half year. So that is key. And is it consistent? Is it going up year after year after year? And number 5, you want a long weighted average debt maturity. So you want the visibility on the payment of debt to be, to be long. They basically want to have it weighted out over years instead of lumpiness, right? Because if you have that lumpiness and maybe interest rates go up, there's not that visibility, and then they're stuck with debt that they've got to pay, that they've got to pay back quickly. That's going to be an issue for a lot of REITs. So I think understanding the debt landscape and understanding that they're managing that debt responsibly is another key aspect. Other factors to look out for. So this is something that I've written on recently before with why bigger is better in Singapore REIT space. Looking at the weighted average lease expiry, the longer the better. Again, that gives you more visibility on what the income is going to look like over the next few years before they have to renew leases. Customer and property concentration. A classic example is Mapletree North Asia Commercial Trust, which obviously has Festival Walk as one of its big properties. That got closed down during the riots in Hong Kong, and then COVID hit. And up to that point, I think they'd had something about 60 to 65% of their gross rental income came from that one property alone. So that kind of underlines, or underscores rather, the potential dangers of having too much of your gross revenue or your gross income in just 1 or 2 properties. Interest rate, interest cover ratio. I think this is, really basic, making sure that the REIT has enough firepower to cover that interest that they owe on their debts. And then obviously you have the weighted average interest rate. I think the bigger the REIT is, the lower that average cost of capital is going to be, and that's going to be beneficial because that doesn't burden them down with debt. They can acquire more properties, they've got more headroom, etc., etc. So it's a virtuous cycle. And then finally, Forex risk management, right? You want the REITs that are increasingly going overseas to be managing that foreign exchange risk responsibly and to be hedging it in cases that they need to hedge it. And if they don't need to, to kind of foresee that as well. Okay, so I'm going to look at the right sectors and structures that you want to be in, right? The key sectors that you should be in as a long-term investor. I mean, here I've highlighted a couple of examples of companies over the past 10 years, 5, 10 years, 20 years that you should really be focused on. And if you look at some of the more sort of, I guess, average REITs over the past decade, you can kind of see Capital Land Integrated Commercial Trust just hasn't been that great of a performer. And yet it's one of those REITs that I think we're all familiar with because we go to those malls every day or every week. We go to Plaza Singapura, we go to Funan, we go to whatever. So I think it's one of those that everyone's familiar with and maybe they're a bit more comfortable investing in. But actually the track record of these types of REITs hasn't been that impressive. And if you think about looking at the big winners over the past maybe 20 years, like the Jardines or the dairy farms, they've been good over the past 20 years, but over the past decade, over the past 5, 10 years, things have changed, right? The retail landscape has changed. And I think they've been caught out. And so you're kind of seeing that feed through into the returns. And so I think being from the Motley Fool, I like to say, I like to invest in the way that David Gardner, the founder of the Motley Fool, talks about winners win. So a winning stock will likely to continue to win because it's doing something right? And the ones that are losing, the ones that are not doing so great, they can continue to suffer because I think they're in positions or they're in sectors structurally that are not going to continue to do well and that are going to continue to suffer longer term. And this is it, right? The REITs are same as stocks. I think it's key to understand that. I mean, this is taken from the Business Times just about 1 or 2 months ago. And you look at the best REITs over the past decade, And there you go. The top three are all got really, really strong sponsors that I'd said before. You know, Mapletree Investments, which is the parent of industrials, logistics, and commercial. It's a super strong sponsor. They've got great risk management. They've got a great portfolio of assets that they can feed off into these different REITs. And these guys have all been really prescient in which kind of sectors they should be focusing on and how they're going to grow that portfolio. So the top performer there, Industrial Trust, actually has a lot of sort of old school flatted factories in Singapore and industrial buildings, but in 2016-17 actually started to move into data centers, and now over 50% of its AUM is in data centers in North America and Singapore. So you're kind of seeing that play out and them shifting and having the foresight to think about where is the growth going to be and where is the income going to come from. And Mapletree Industrial Trust is a great example of a REIT that's really been able to pivot really well. And you're kind of seeing that in the returns, right? You're seeing that in the returns, and you're seeing that in the DPU increase. It's averaged about sort of 5% annual growth over the past decade, which is among the best in class. And so all these REITs here are all in really, really strong sort of structural sectors, I think, and they'll continue to perform well based on what I've talked about earlier. And own the REITs with a real track record, right? I mean, this is what I talked about with Mapletree Industrial. It's got a consistent DPU increase year after year after year. It continues to increase that DPU. And there's a dip, obviously, a little bit temporary during the pandemic where they had to retain some income. But compared to some of these retail REITs that cut their DPUs by 60, 70, 80%, I mean, it was nothing. I think they cut their DPU on a year-on-year basis by maybe sort of like 10, 15%. And then it's on its march upwards again, right? So thinking about it over a 3, 5, 10-year period is actually really key. Don't look at the DPU, say, over 1 year, 2 years, because maybe there's a little bump from an acquisition. I want to see that continue to rise over 5 years at least. If they've got a 5-year, 10-year, the longer the better, I say. If you think about what you want when you buy a REIT, you want that dependable income, right? You want it to come in quarter after quarter, year after year. And especially if you're nearing retirement, or if you rely on that income, you actually really want that income to be as secure as possible. And so owning the REITs with track records that have it, potentially maybe with a bit of a lower yield, is preferable to buying a REIT maybe with an, 7, 8, 9% yield, which just really has a danger of cutting that dividend or it falling, right? So I think that's a key aspect to understand when we do invest in REITs. So overall, how is the REIT market changing? I think we can understand that structural growth stories are going to continue to sort of ride the tailwinds of the REIT market. And it's not really going to change, right? I don't think we're going to go back to the old way of doing things and, continue to shop in stores every day. I mean, for example, the grocery retail market has changed, right? Beyond recognition. People are now ordering their groceries online. They're not used to going, I guess, into the cold storage or the fair prices every day and getting their groceries. They're very happy to do that online. So I think once that behavior is kind of entrenched, it's going to be difficult to go back. And I don't believe we will go back. But further out, I think ESG is actually going to play a really important role in real estate, understanding how much of a carbon footprint certain properties give off. What are these REITs doing in terms of their management of sort of carbon emissions? How are they reducing carbon emissions for their properties? Are they putting solar panels on their roof? Are they making it, more ESG friendly? So I think these are things that our investors are actually going to watch, because beyond doing their part for the environment, they're actually going to cut down operating costs as well, which is, so it's a win-win situation. And then finally, property income streams, I think they're going to remain in demand. That's just given low interest rates globally. And if you think about property, what I like to say is actually nearly indisruptible or undisruptible. I mean, it's one of those sectors that there will always be demand for property. It just depends on what type of use it's going to have, right? Property that maybe used to be retail, maybe it'll get changed into data centers, or maybe it'll get changed into logistics properties. So property demand will always be there. It's just a type of property that you're going to see in demand that will change. Hi, I think I've shared enough for now. So let's take a short commercial break and allow me to share with you a little bit about ProsperUS by CGSIMB. ProsperUS is a digital investment service launched this March that was built by millennials and for millennials, and everyone else in mind. We aim to provide you with a best-in-class service when investing online. And as part of our educational efforts, we have specially curated series like webinars hosted by investment gurus such as myself, so anyone can gain more insights on investing responsibly over the long term. We also share bite-sized investment insights on our website, our social media accounts, and our dedicated Telegram channel. Okay, so next I'm going to hit growth stocks in the US, right? I mean, you're looking at stock markets in the US hit all-time highs. Everyone's wondering what's going on. Is a crash coming, et cetera, et cetera. But we kind of ignore the fact that there are so many strong tailwinds for growth stocks actually in the US over the next 5-10 years. And so if you think about technology and how that's changing, the way that we invest, the way that we live our lives, I think that's not really taken into account by a lot of investors, and the amount of growth that's left there is still substantial. And when you talk about growth nowadays, everyone might be talking about crypto or using leverage and getting massive gains in the crypto markets with some random coins, but growth is actually about buying companies' revenue streams, looking at revenue growth, tapping huge total addressable markets, which is also known as a TAM, and also trying to focus in on relatively smaller market capitalizations, younger companies. Not to say that companies like Microsoft and Amazon and Apple, Google are not great companies. They're amazing companies, but they're also, around 2 trillion in market cap. So are they going to grow to be 20 trillion? Are they going to, grow 10 times in the next 10 years? It's quite hard to imagine that they will. So I think when you look at growth, you want to be looking in the right market cap space. You want to be looking at sort of the 10 to 20 or 25 billion market cap space where, that growth is going to be there over the next 5-10 years for them to grow into larger market caps. And obviously thinking about valuations right now, current prices right now are based off the future cash flows, right? So if you're looking at guidance on earnings, if they raise guidance, those valuations stay the same, the valuations are gonna go up, or price is gonna go up because valuations are being lifted by guidance. So if you think about the growth potential of these companies, it's still there, and you just have to find the right opportunity. So that's the key, and that's hopefully what I'm gonna try and share with a little bit with you guys today. Okay, so why invest in growth stocks? I think there's that whole dilemma about should we just put it into blue chip stocks that pay reliable dividends, which is great. So I think there is definitely a place for that in every portfolio in terms of how you construct your portfolio, but there's always a place for growth as well. One of the reasons I love to own growth stocks myself is that you want to be positioned in disruptors, right? You want to be focused on buying the shares of companies that are really actually changing livelihoods and challenging the incumbent business model. I mean, thinking about Amazon and delivering, what it started out delivering books, and then it's turned into an online retail giant. And if you think about Netflix, it started out as a DVD mail order business, and look what it's turned into today, right? And they've totally disrupted the traditional model. And if you think beyond that, that's also reflected in the share price. So if you'd invested in Netflix in 2010 or 2005, or you'd probably be up sort of 20-30x. And so buying the companies that are going to change the way that we live, and buying the companies that are changing livelihoods globally, that's going to have an impact, and that's going to be reflected in the share price. And obviously you have to be, as a long-term investor, you have to have that long-term horizon. You have to think about these companies' stories and these businesses, and you have to own them as a business owner and think about where that's going to be sort of over 10-15 years, preferably longer. And so you have to be comfortable with some of that volatility, because some of these growth names this year, they had a great 2020, and this year they've maybe not performed as well. But does that mean you have to bail out? If the business is still performing, I think you should still be in there. If your thesis still holds up, I think you should still be in there. So I think it's a game of thinking about growth and long term, and also patience. So it's a combination of all that. Okay, so I'm going to hit up one of the interesting trends I think people are talking about longer term this decade. And obviously digital payments is huge. I mentioned crypto earlier about how that goes into payments as well. But I think if we think about digital payments generally, that's something that's still taking up a lot of bandwidth in terms of the conversation. And so cash is trash. That's a classic quote from Ray Dalio, an investment guru, and the manager of Bridgewater Capital. And so if you think about digital payments and the cost of acquisition for some of these banks when they acquire a customer, it's extremely, extremely high, right? So if you think about look at the chart on the left and think about acquiring a customer for a credit card or for an account, it's a lot higher than if you try and acquire a customer digitally through a wallet, right? Because if you can scale that online and you can reach 1,000, 5,000, 10,000 online by scaling that wallet, the CAC, or the customer acquisition cost, comes down dramatically. And so you're starting to see that play out in a lot of the names that are coming up now, such as PayPal, as Square. They're all building these ecosystems that are aimed at making banking and payments just basically frictionless. And so the space itself is really exciting, based on the fact that only a fraction of overall payments are still made online versus cash, right? So I think that's something that we have to also take into account. There's still a massive runway for growth for this industry, and that will continue to flourish, I think, over the next decade. And that kind of ties into the second point that I'm trying to make here with e-commerce. So I think last year you saw a massive massive pull forward of revenue growth for some of these e-commerce companies. That also played out in the digital payment space, as I said, for PayPal and Square, just because people were obviously not transacting in cash. They were buying things online and they were using these products. But if you think about actually e-commerce itself, it's still at really early growth stage in the US, right? So even in 2020, even though you saw massive growth, the overall penetration rate in terms of the overall take of online retail is still below 20% of the overall retail spend in the US. So if you think about that versus China, which is already really saturated, the chart on the right, I think you have to really think about what is the growth runway for these companies that are just starting out and have obviously had a massive pandemic boost. But over the next 5-10 years, can that continue to grow? And the answer is obviously yes, right? There's a massive runway still there to take advantage of. And I personally think that runway is more exciting in the US, in the West, than it is in China, where everyone is already quite used to transacting online. So it's become more second nature. Whereas in the US, you're just at the early stages of that playing out. And the great thing about it is you don't need to just invest in an Amazon or just invest in sort of a Walmart. You can actually invest in specific niche e-commerce verticals. And that's a great thing about, I guess, e-commerce in the US, is that there are actually specific companies that are attending to specific needs in the US market. So for example, in pet care, if you think of the left-hand side, online pet care spending is starting to rise. And so if you think about a name like Chewy, which is a online pet care goods retailer, they've built out an amazing base of users that are using their platform to deliver, I don't know, dog food and cat food on a regular basis, things you would buy maybe weekly, but you don't want to lug all the way from your local shop or from your supermarket, so you get it delivered to your door. And on the right-hand side, we have Etsy. And so Etsy is effectively the anti-Amazon. It produces niche, handcrafted, artisanal goods by a massive database of their own sellers, and then there's a buyer network, which is obviously if myself or you were to go onto Etsy and look for a good that we want, or a special present for maybe a family member or a friend, and we want something that's not really so common that's out there, we would go onto Etsy and we'd take a look at it and see if we could get something handmade. And so I think the great thing about that is that it's actually custom made, so you can get whatever your mother's name engraved, or you could do something with your best friend. So there's always that customization aspect that you don't have on Amazon. So all the goods that you find on Etsy are actually really not available on Amazon at all. And so what Etsy has done is they've really grown that whole database, and they've grown that network of buyers and sellers, and that's sort of kind of become a flywheel now, and it's growing. And so they've got a stable of brands under the big Etsy brand. They've got Reverb, which is a secondhand musical instrument site, which has done really well since they acquired it a few years ago. And earlier this year, they actually acquired Depop, which is a secondhand clothing retailer. So if you think about the clothing industry generally, it's actually one of the most polluting industries globally. And younger people now are actually really comfortable buying their clothing secondhand. They actually don't need it because they actually have a much more sort of, I guess, sustainable mindset when they buy things. They want what they're buying to be, environmentally friendly. They're environmentally conscious when they make purchase decisions. So Depop has been a really, really big success in the UK, and Etsy has acquired that earlier and is integrating it into its stable of brands. And then finally, Elo7, which is effectively the Etsy of Brazil. And so that, again, has got a really good network of buyers and sellers in Brazil, where e-commerce is still a really small fraction of overall sales. Okay, so one of the big winners, I think, of this whole trend, and which maybe flies under the radar a bit because it's not an Amazon, it's not a, it's not a Walmart, it's not a one of the big sort of retail names that you see every day, and that's Shopify. And so Shopify, what it effectively does, it actually builds the digital storefront for merchants. So if you're a small or medium-sized business and you're, I don't know, selling sort of sandals online, you might have to go and build that shop yourself and get developer and get, and a coder and get everything kind of set up. And that really, really raises the price of setting up online. And so what Shopify does is that simplifies the whole process for merchants. It just gives them an out-of-the-box solution for them to build their own retail site, and then they can start shipping to customers. And so they deal with marketing, they deal with payments, they deal with fulfillment. So they help merchants really get their goods out to customers and get their brand out to customers as well. And so you can kind of see that in the numbers, right? In the last sort of quarter or 2 quarters, they've managed to hit over 1.75 million merchants on their platform, and they're in currently 175 countries worldwide. So they're global, but the majority of their revenue is still based in the US. So they're early days in their international story. And so if you're just getting started, it only has, think about the share of overall retail online sales in the US. Amazon has about 38-39%. And Shopify merchants, combined only have about a 9% market share in the US. And so the trend is actually for more and more retailers to go direct to their customer rather than go to an Amazon and sell on Amazon. Because when they sell on Amazon, they don't have control of the narrative of their brand. They don't have control of, the shipping of their goods. But when you get Shopify's software, you get Shopify's tools, they give you that power. So I think Shopify has really given merchants the power to go out to the market and sort of build their own brand and give it to the consumers in the way that the consumers see fit. And it's grown, right? It's grown its optionality. So I think when you think about growth stocks, what you want is optionality. Optionality is a key thing because optionality gives investors the opportunity to see, like, where is this business going to pivot to and how is it going to find new growth avenues? And so if you think about Shopify starting out basically just as an online storefront provider, it's grown, right? It's now looking at fulfillment. It's now in Shopify payments, which allows merchants to process payments on their platform. It's also partnering with some of the biggest social media providers out there. So it has, since Facebook started their own shops, product, they've kind of partnered with them on that. And then interestingly, actually, over the past quarter, they've actually partnered with Spotify. So I find that really interesting because Spotify, you wouldn't think of as an e-commerce platform, but now what they're doing is they're integrating Shopify's tools into Spotify so that artists on their profile page can start selling their merch or their merchandise to their followers. And so by allowing Spotify artists to actually tap into their consumer base, Shopify again is empowering its clients, and in this case, Spotify artists. So I think that optionality is great to see, and it's continued to grow, right, from strength to strength over this whole period. Okay, I'm going to hit my second big emerging trend. So I think if you've seen, obviously Facebook has changed its name. It's now the metaverse. This is huge. We're going to be living in the metaverse in the next 10 years. There's a lot of hype around this theme, but it's not necessarily concrete if you saw Facebook's presentation, how they were going to make money from that. So I think Meta, now Meta, how is Mark Zuckerberg going to direct the company to make money from this world that they want to build, right, that Facebook wants to build? And so if you think about investing in the emerging tech of it, I like to think of investing in the picks and shovels place. So that means invest in the companies that are building these kinds of worlds. So if you think about the metaverse and where it's going to be in sort of 5-10 years, what Unity software does is actually it's the largest gaming software development engine in the world. But it's growing. It's growing outside of gaming. Again, that optionality comes back, right? It's actually using its software and its development tools to kind of grow the metaverse and its whole immersive world, whether it's in augmented reality or in virtual reality. And one of the key drivers of that is Unity's demand for real-time 3D, which is powering sort of new partnerships with companies beyond gaming. So if you think about trying to invest in the metaverse, the best way to do it is you don't know who's going to win in that race, right? It could be Roblox, it could be Facebook, it could be any other amount of companies that are doing things in the metaverse. But if they're going to be doing those things in the metaverse, they're most likely going to be using Unity software technology to build those environments. And so think about how the monetization of that is going to be key, right? So in the metaverse, on the right-hand side here, we can kind of see PwC thinks in 10 years or by the end of this decade, it's going to be worth over 10 times what it is now. And it's already working with companies in the sort of film studios and as well as architects, as well as auto companies. So what Unity does is it is actually providing the tools for these companies to build these worlds. And so it also allows within its suite of development tools to actually monetize it. So that's a key thing. They can actually monetize these worlds, and that is something that has been key. So for a lot of the gaming companies, I think gaming has been a really good sort of framework for what the metaverse will look like, because in gaming you can already start to monetize users, whether that's through add-ons or costumes or whatever it is. Gaming revenue has continued to go up and to the right over the past decade, and that's because they've been really creative about how they monetize their users. So one example for Unity recently is they've actually launched Unity Metacast. And so what that is basically blurring the lines between the real and the live worlds of sport. And so effectively what you can do now is you can maybe go and look at a UFC live match in immersive 3D or in augmented reality. And if you kind of think about the opportunities to monetize off that, you can think about what is a UFC fighter wearing, what kind of stuff is he wearing, can I buy that, where can I buy that? And so there's going to be a whole user journey, and that also ties into the e-commerce factor. So thinking about how to monetize the metaverse is going to create what people are already talking about as Web 3.0, right? So it's going to be able to create multiple streams of revenue generation. And so Unity is going to provide those tools for the companies to do that. And an example at the bottom here, as I've mentioned, is Unity mediation, right? I mean, they're already starting to look at tools to improve how developers can better monetize by streamlining the ad bidding process, understanding where the best bids can end up winning, and understanding where these companies can sort of monetize best in terms of their users. And so Unity is not sort of alone in this, I guess, this metaverse theme, but I think it's alone in the fact that it stands as a more broad play on the actual story, and a really monetizable play at that as well, rather than saying, oh, we're going to build this metaverse world and we're going to monetize it like this, even though it's all at this point in time, theory, at least in maybe Facebook or Meta's case. So Unity provides a really, really sort of concrete way of playing that theme. And so what do we want to do when we pick these tech winners, right? What are the lessons for picking them? I think first off, you want that large TAM, right? You want that large total addressable market, because that provides a growth runway. Number two, you really want first mover advantage. If you think about Unity now, it's already the largest gaming developer. They serve 94 of the top 100 gaming companies. They count as customers. And what they build, it reaches 2.5 billion people every month. So in terms of the kinds of products that they build. So they're there, right? They're the first mover. I mean, there's them and there's, I think, is it Fortnite or Epic, rather. Epic Gaming is the other one. That's, the big gaming engine. But Unity's really sort of carved out a niche for itself. Number three is, optionality. You want it to have that optionality, as I said, to gain more revenue. Where are they going to find new ways to grow? If you think about Amazon, no one would have ever thought that they would have been in Amazon Web Services, but they found that way to grow, right? And now look where they are. In many cases, founder-led firms, they tend to have alignment of incentives. It's usually their baby, the company. They want to keep it growing. They have real passion for the business. They have a mission. They're quite mission driven in how they want to build this business. And so when you see in the tech world, there are a lot of founder-led firms, and I think those are the ones that tend to be ones that you want to focus on when you're trying to pick the winners. And then finally, winners win. I mean, quality, it costs money. It's kind of like luxury goods, right? You pay up for a luxury good, whether it's a Gucci handbag or a pair of Ray-Ban sunglasses. You're going to get quality. But if you buy something cheap, and if you buy something that's perhaps not up to what you would think is quality, and you expect it to be a luxury good, you're going to be sorely disappointed. So I think that's the same thing for stocks. We have to understand that Stocks are no different to a lot of other things, where if you go to a nice restaurant and you pay good money, you're going to get good food. I think that's the same thing with stocks. Quality costs money. So I think a lot of the time valuations put people off. But to me, valuations are a sign of quality. If the valuation is higher and it's consistently higher, that probably is a good sign that this company is doing something right. You talk about Amazon or Netflix, people have always said it's been too expensive for 5-10 years. So you would have never bought it if you think about the valuation of it. And obviously you would have missed out on some incredible gains over that time. So, and that's it for me today. I think I want to kind of mention that I wanted to add on about ProsperUS, that we're always coming up with new account opening promotions. So just make sure to follow us on our social media accounts and check out our website for more details. If anything I've shared earlier has caught your eye, sign up for an account today or request a free demo account on our website if you're not ready to take the plunge. I hope you've enjoyed and learned something new from this short 30-minute session. And if you're interested to find out more about investing or about ProsperUS, drop us a DM on Instagram or shoot over an email to hello@prosperous.asia. We're always here to help. Bye.